Rich Clarida unmoved. Do you think that's the right reaction? What is your reaction to today's number?
Well, I think we're at a bigger turning point than the Fed's going to be describing at this moment, which is that you've totally embraced what we call monetary policy 3, but the merger of fiscal and monetary policy. And it's purposely trying to drive the inflation rate up, and it's being successful, right? And so you're seeing in the numbers, finally, the CPI numbers catching up with what everybody measuring prices on a bottoms up basis is seeing. That this is a real phenomenon. When you create this much demand without creating that much offsetting supply, this is the natural kind of fate that we face, which is rising inflation. And in a lot of ways, that's a good thing and a necessary thing.
Do you need to hedge it then? And how would you do that?
Yeah, well, mostly we think that most portfolios are too exposed to very long duration assets where the cash flows are very far in the future, and places that require continual Fed liquidity. Shifting those portfolios to portfolios that'll benefit from nominal GDP growth and won't be too harmed by a loss in liquidity. Basically, there's a lot of cash flows out there that are available that are more attractive than the bond yield, but you need to hedge them with bonds. So normally, a traditional portfolio, you think of, well, you want to be long bonds to hedge equities if growth goes down. But in this world, in this MP3 world, you really got to hedge against a stagflationary environment where rates are rising, but growth isn't that great. And to do that, you really need to make sure you're holding cash flows hedged with bonds. That's the opportunity the Fed policy is giving you right now, is their cash flows that are better than bonds, but they're extremely vulnerable to a rise in bond yields. So it's really important to get that hedge.
Bill Dudley's been very prolific writing for Bloomberg Opinion over the last few days. He is very much of the view that the market is underpricing the upside risk on the US 10-year. The the 10-year Treasury yield, he says, could more than double from the current 1.66%. And if persistent deficit financing prompts concerns about growing US debt, the yield could go 4% or higher. He basically says that there are plenty of people in the market that have never really seen anything like this. Greg, what do you make of those kinds of numbers?
Yeah, I have to agree. I mean, I think that everything is happening in warp speed here. So that you had reflation and warp speed in terms of the policy response, that basically things happen 10 times faster than they did in the financial crisis in terms of the rebound in asset prices. And you're starting to see a version of that in the real economy. And so people used to bonds moving very slowly could be quite surprised. The Fed's going to get pulled along with it. Now, the Fed is obviously not going to let the bond yield rise if it has a big impact on the economy. But due to this MP3 world, where fiscal policy is much more important than the traditional interest rate cycle impact on the private sector, that you could see an accelerating economy and rates getting pulled up by that accelerating economy, the Fed lagging that, but that hitting financial markets before it hits the real economy, because the real economy is driven by this fiscal impulse, not the normal interest rate driven private sector cycle.
So does that mean that at some point the Fed's hiking cycle will be faster and tighter if we're kind of moving everything in that direction? Or does it mean they're just going to be lagging quite a bit?
Well, I expect that they will lag. They have learned they don't want to be preemptive to inflation. They're going to lag. They're going to be slow. But the market's pricing in a degree of slowness, which we don't expect. That to say 2 years from now, where you probably have inflation rates significantly above target, unemployment rates at quite low levels, that you only have 25, 35 basis points of tightening priced in, that's probably the biggest risk factor in markets, is if the economy accelerates faster than that, particularly in an inflationary way, that the Fed could be at 200 basis points, not at 25 basis points over a 2-year period. And the market's not prepared for that. Financial assets are not prepared for that. So again, that's another place to look for potential hedges, having some assets that'll do well with nominal growth, but offsetting that with short Eurodollar positions or other positions that'll be okay, that will offset the risk of rates rising.
Greg, how much fiscal do you think is priced into the market right now? How much fiscal do you think we're actually going to get? The political pressure not to deliver more, not to supercharge this economy even more, has to be growing at this point. There's going to be a meeting later on. I suspect this is going to be talked about at the White House. Do you think the Biden administration is going to deliver everything it promises right now?
Well, I don't think they'll be able to deliver everything they're talking about, but you basically have turned a corner where fiscal policy is seen across most of the political spectrum as a very viable tool for getting out of recessions, much more useful. So now you could 2 years from now end up with divided government, and it might be a different story. But for now, any downturn is going to be hit by fiscal. And while I expect you'll get a major infrastructure bill, despite not having much bipartisan support for it, simultaneous to that is the past fiscal policy still hasn't flowed through because of the pent-up demand due to the pandemic that's still there. If you look at household savings rates, they are still excessively high. They're going to come down almost certainly by the end of the year. You're looking at demand increases in the U.S. economy, we'd say from 8 to 10%. Now, a lot of that, some of that will pull from real GDP, but some of that will probably create even further shortages and more inflation over that period. So we'll be expecting, you'll be looking at significantly higher inflation than the Fed expects when you're looking back a year from now.
Which goes to your too much in long duration assets, that you're worried that investors are too much into that trade. So then I guess the question, where are you short? So how do you express that on the short side?
Well, I think as I was describing, hedging with short bond positions and potentially short Eurodollar positions is one thing. And then within the equity market, being very wary of the stocks that have benefited from massive liquidity and have very long duration cash flows. If they're losing money today, they're going to make money 10 to 20 years from now. That cash flow is super vulnerable to the discount. Is that
tech? Are you basically describing tech?
Well, different within tech, you've got some generating incredible cash flow, and you have some that need to grow like Amazon did to be at all reasonable. And so you definitely have within tech, huge differences across those. And then when but you are right to push more towards those countries and those sectors that are going to benefit from nominal GDP growth and not be so long duration. Also those that won't be so harmed by the move in margins. So you're going to see wage pressure, you're seeing commodity pressure, and you're seeing tax pressure in the US for corporations. Other places in the world, you don't nearly have as much margin pressure. So outside of the US, we think there's some good opportunities, particularly for the marginal supplier to this surge of demand in the US.
Can you be more specific there?
Well, we don't really get into particular positions, but we think European equities are
but
reasonable.
Is it Europe? Is it Asia? Where are you, kind of just geographically, where are you seeing that?
Yeah, I'd say Europe and some parts of Latin America that are particularly going to provide what the U.S. needs. Some places in Asia as well, but that it's more so outside the U.S. The equities that benefit from growth less than liquidity, and those are the places where where our positions are larger.
Yeah.
And then all of it, though, everything is going to be affected by the move in the discount rate. So really making sure you have that, short bond position or at least lower than normal investments in bonds is a big deal to basically hedging the biggest risk to assets.
Also, 2020, if one was on the wrong side of trades, it was pretty brutal. You guys did have a 13% loss for last year. So what kind of pressure are you under to kind of reverse it? And how aggressive do you feel like you have to be in that?
Look, we always just try to get the odds in our favor. We have a systematic approach that we've built based on 45 years of studying markets, and we get things wrong sometimes, and people understand that. Or the losses were consistent with the 4 other times that we had losses back to the beginning of Pure Alpha in 1991. And so this happens. We're going to get things wrong, and we're not going to try to reverse that by shooting the lights out. We're going to take a disciplined approach that doesn't have a long-term correlation to the equity market or anything else, that it's true alpha. And over time, expect to have a winning percentage that's good. And so we've had periods that are bad. We did have a bad year last year. Since April, we've had returns totally consistent with our normal expectations. And we're not trying to shoot the lights out. We're trying to have a disciplined approach to creating alpha by understanding this environment. And we think this environment is creating some of the best opportunities that we've seen in 10 to 15 years because the way policymakers are pulling the levers are so different across countries.
We're moving pretty fast, and a lot of things are getting kind of moved around as a result of that. Greg, is your portfolio more diversified now than it would normally be? I'm just kind of wondering how more thinly is the wrong word, how much more spread out you are in terms of your asset allocation.
Well, I think that, I mean, we always have a very diversified portfolio. And I think it's so critical, you know, that generally, if you look at the risks in the world, having good global diversification, most investors are massively overweight the US, both on the interest rate side and on the equity side. And so diversifying across the world and being diversified to the range of ways these policies are likely to play out, which we think are either kind of a reflationary boom or a stagflationary pressure. And you have enough assets that'll be okay in a stagflationary environment, and you have enough assets globally diversified because the way different countries are handling this circumstance are so different. And that's the conversation we're having with a lot of our clients and trying to get people to recognize the benefits, both long-term, but also today, in terms of getting much more diversified than they are.